Happy Monday, everybody. Today is November 24th, 2025, and this is your Monday market update. Now, I hope you had a nice weekend and you're easing into this short holiday week. As we head towards Thanksgiving, markets are wrestling with a lot all at once. Delayed economic data finally catching up, AI expectations resetting after NVIDIA's monster print last week, and a Federal Reserve that still hasn't quite signaled where it wants to land in December. Now, before we dig in today, I want to start with something simple. Thank you. Thank you for your trust. Thank you for your conversations that we've shared this year. Thank you for inviting me into your financial lives, your goals, your hopes, your families, the transitions you're navigating, and the futures you're building. It continues to be the privilege of my professional life. Now, in Monday fashion, let's recap last week and we'll preview the week ahead. Markets kicked off the week with renewed volatility after an already bumpy November. Stocks opened lower and never really found their footing, driven by increasingly hawkish money flows in the bond market and a notably hot Empire manufacturing number that caught traders leaning the wrong way on that one. So Fed speak didn't help at all. Comments from Vice Chair Jefferson highlighted the tension between Fed mandates, which only accelerated the move higher in yields. Later in the day, two soft Treasury bill auctions, both issuing higher yields than prior, added fuel to the fire. To add to the uncertainty, President Trump made headlines with aggressive remarks on U.S. positioning in the Caribbean, hinting that even a strike on Mexico was not out of the question. That geopolitical tone briefly pressured markets into the close. Stocks ultimately closed near session lows as traders hesitated ahead of NVIDIA earnings, delayed government data, and a macro backdrop that still felt unstable. The Dow was down 1.25%, S&P down just under 1%, and the Nasdaq was down almost 1%. Tuesday brought more choppiness as futures opened in the red but stayed above the prior day's lows. Markets were stuck in a holding pattern, waiting for NVIDIA's earnings, delayed economic prints, and of course a steady stream of Fed rhetoric. Industrial production and import prices were soft. Housing sentiment slipped again. Fed heads Barr and Barkin, they both spoke during the session, but neither shifted the market's outlook. The mood was simple: get us to the data and get us to NVIDIA. Meanwhile, gold and copper sold off on the back of the stronger dollar, while oil held relatively steady ahead of the holiday travel season data. Metals saw broad declines after Monday's hawkish flows and geopolitical tensions related to Venezuela and Russia. They still remain in focus. Overall, it was a market looking for direction and willing to wait one more day. The Dow was down almost 1.25%. S&P was down just under 1%. The Nasdaq was down over 1.25%. Wednesday was the quiet before the storm. NVIDIA earnings were looming after the close, and the traders largely stayed on the sidelines, trimming risk and keeping liquidity tight. Economic releases were sparse, but fixed income markets firmed slightly after several days of selling pressure. The dollar did hold some near recent highs. Gold hung right around that 40.50 level, and oil hovered below the $60 level after Russian export headlines. Markets were in an elevated sense of general uncertainty, and positioning was the theme of the day, not conviction. Everything was about the next 24 hours. At the close, the Dow was up slightly, S&P up almost 0.5%, and the Nasdaq was up just over 0.5%. Thursday should have been a victory lap for tech. NVIDIA delivered another monster quarter with revenue jumping so sharply from Q2 to Q3 that the roughly $8.4 billion in sequential growth exceeded the entire quarterly sales of more than 370 S&P 500 companies. That's big numbers. But instead of lifting the markets, NVIDIA's blowout numbers raised a more uncomfortable question. Do we actually need all of this AI capacity? That skepticism did not take hold immediately. Stocks opened with big gains. Futures were up more than 1.5% pre-market, but those gains did fade fast. The delayed September jobs report initially looked strong, but the details were somewhat troubling. Unemployment rose to 4.4%. Wage growth is still sticky at 3.8%. A data mix that looked, in their words, like a stagflation whiff. Then came the Fed. Hammack warned that inflation was still too high. Cook said that there was increased likelihood of an outsized asset price declines. Goolsbee even openly questioned whether massive AI expenditures could be another tech bubble. By midday, NVIDIA itself reversed lower, and the rest of the market followed. What started as a strong morning turned into an afternoon slide, with the S&P 500 breaking below its October low near 65.50. The Dow was down more than 0.75%, S&P down over 1.5%, and the Nasdaq was down more than 2%. Brought us to Friday. After Thursday's washout, cooler heads prevailed. The stagflation panic faded as investors digested the data and realized the labor market is cooling but not collapsing. Crucially, comments from New York Fed President John Williams signaled that a rate cut is still very much on the table for December. That was big, and that was the green light the market needed. Buyers stepped in to pick up all the pieces. The Dow rallied to up over 1%. The S&P 500 finished up roughly 1%. The Nasdaq recovered just under 1%. Wasn't enough to erase the week's losses, but it was a strong finish that suggested long-term trend is still intact. It was a tough week for markets, not because the data was disastrous, but because confidence took a hit. AI leadership cracked, economic prints revived stagflation worries, and the Fed made it clear they're not ready to ease prematurely. For the week, the Dow was down roughly 1.5%, S&P down just under 1.5%, the Nasdaq was down close to 2.25%. The themes were clear. Too many questions about AI capacity and capital expenditures, higher unemployment plus sticky wages equals a troubling mix. And market leadership is narrowing as mega cap enthusiasm faded. This week is shorter, but it is still meaningful. Key data will all be on tomorrow, Tuesday, and Wednesday due to the holiday. Of course, Tuesday we're going to get retail sales, Case-Shiller home prices, consumer confidence, and pending home sales. Wednesday we'll see jobless claims, durable goods, and the Fed's beige book. Nothing more after that. Markets are closed on Thursday and open for half day on Friday. And if you want to know the origins of that half day, stick around to the end of the video. Some themes to watch this week and going into the end of the year. Does the AI unwind continue, or does bargain hunting show up? Does the beige book confirm or contradict Friday's stagflation worries? What happens to Treasury yields? The 10-year does remain in the low 4% range. That's fine for stocks unless growth fears accelerate. Liquidity into the holiday trading, that the thin markets can exaggerate moves, so we'll have to watch that, and that can go in either direction. The market wants clarity. It might not get it this week, but the pieces are starting to fall into place. December's Fed meeting, 9th and 10th, is now the next major waypoint. They're not going to get major inflation data before that. We are about to hit the last month of the year. There's a lot to do in the market updates and the planning side. I am starting my Friday series this week that will last until the end of the year with lists of things to get done before the ball falls in Times Square. Check it out, Friday. Have a great short week and keep planning. Now, if you want some trivia, here you go. Why is the market open a half day on Friday? Now, after the Great Depression, a law was passed that prohibited the markets from being closed for 3 consecutive days to ensure that investors can maintain access to those funds. Now, the trivia part, when has this law been violated? Of course, in modern times, following the 9/11 terrorist attacks, also during Superstorm Sandy in 2012, and that's when the New York Stock Exchange closed on Monday and Tuesday following the normal weekend closing. Following those two events, there's been a lot of work to have alternative sites in case New York cannot or should not be accessed. Let's hope we don't have to test that anytime soon. Now, one more time on a different scale and a bit longer ago in 2007 when Gerald Ford passed away, December 26th, and the day of mourning followed the New Year's Day holiday. That was a 4-day closure. So impress your family at the Thanksgiving table or not. Anyway, have a great Thanksgiving, have a great week, and we'll talk to you soon.